Sure.
All right, welcome everyone to the monthly edition of the Power of Passive Investing Meetup. Um, Today we have another exciting guest to join us. Alex is joining us and will speak to us. I'll do the quick intro as always for the group. Glad to have you all join. As you know, this is a educational focused meetup where we have guests come on, speak about specific topics, and allow us to kind of consume the data and ask questions and just get more familiar with real estate and areas around real estate, help our own kind of journey through whatever it is we might be, whether it's the first deal, 10th deal, or whatever, wherever it is you are, or just piquing interest. Just as that's my reminder, just educational purposes. No, nothing today should be considered investment advice, as our not attorneys would say, right? And make sure anything that's kind of said today, you go ahead and validate with your legal or tax professional. So today's everything's just all for informational purposes. So just wanted to kind of put that out there again. Like I said, this is a monthly meetup, so we always have this. We record live on the first Wednesday of the month, and for those of you that are watching this after the fact, you'll know this is also posted on YouTube for you guys to check out after. So happy to do that. Happy to interact with you guys offline. Alina is on vacation herself down at the beach at the Jersey Shore today, so I'm yeah, good for her, right? So actually, I gave her some restaurant recommendations to check out this evening, so hopefully she's enjoying one of those. One of those tonight. But great, Alex. Thank you for joining us. I know you have an awesome background. My favorite, I think Alina even put it in her newsletter, is you're a published author with Bigger Pockets, which we all know and love, and many of us, that's kind of where our real estate journey started. So I think many of us hold Bigger Pockets and the brand around it near and dear to our hearts. So why don't you just start by maybe telling us a little bit about your background and who you are, and then you have a presentation to share with us today about private lending, which is really interesting, a topic that we haven't spent time and deep dived into. So that'd be great and interesting for us to hear today. So why don't you tell us a little bit about your background?
Yeah, absolutely. Thank you, Matt, for having me. And your group is appropriately named because my personal mantra is I invest passively so I can live actively. This fully resonates with me. So I appreciate the opportunity to kind of share that interest with other investors because I think the active investor community gets a lot of limelight when you're talking about Bigger Pockets. You know, the burring and the flipping and like all of that is very bright and very sexy. And then it's like private lenders, like, what are we going to put on Instagram? Us like emailing over loan documents? Like, it's not
Excel
something
documents,
we're
yeah.
not yeah, they're not going to have like flip that paper like they do flip that house on, on TV. It's just not something, that's that big flashy sexy thing. So I'm happy that there's people that actually go out and look for passive opportunities, and one of those passive opportunities is private lending. So like Matt mentioned, my name is Alex Breshears. I'm one of the authors of the private lending book that was published last year with Bigger Pockets called Lend to Live. It's actually got 15 words in the title. Don't ask me what all 15 words are. I just know we named the book Lend to Live, and then Bigger Pockets added 12 more words after that for SEO optimization. But here we are. But really, the book, I try to bring this to investors' attention, whether they're passive or active. But the book was designed to have someone be able to do the journey of doing a private loan. But it's also really good for active investors because if you're an active investor that wants to raise private capital for your deals, this is something you can hand someone and say, hey, if you want to invest with me, do you want to be my lender? And then talk to them about what the lending process looks like. And then you look like the informational guru in your little network because they're like, oh, this is how I'm going to safeguard your money. 1, 2, 3, 4, and 5. And we're going to talk a little bit about that in the presentation at a high level, the kind of various safeguards. So even though the presentation I have is specifically related to, how to be a private lender, the information actually works in both directions. I'm just giving it from the perspective of how to be a private lender. That doesn't mean an active investor can't turn around and then say, hey, if you want to invest with me on my deals, here's how you could do it. You could be the lender, you could be the bank and here's how that works. So I just like to let investors know that it'll sound like it's coming from one direction, but it's actually applicable in both directions. So with that, I will happily get things kicked off here. I'll share my screen. I'm not too big on the PowerPoint having a whole bunch of things, so it's not super wordy. So I like to have it so people can actually listen to me instead of spending a lot of time reading. But like Matt mentioned, my name's Alex Breshears. I am the CEO. My lending business is called TC Capital. I lend specifically in Missouri, Virginia, and we've done a couple deals in Kentucky, one in Washington State. So the nice thing about private lending is it allows for a great degree of flexibility. And as seen here, we can lend in the states that we choose to lend in. My spouse is active duty, so he actually lives in Europe right now, and I live in the United States. And so I travel back and forth to go visit him. He travels back and forth. I live in multiple houses across 2 different states to stay with family while he's overseas. And that's usually not a luxury a lot of active investors can do, especially if you think about if you're taking on a flip. If you leave for 2 weeks, there's no telling what could happen to your flip in those 2 weeks. So you have to be involved. You have to be there. So that's the other thing I like about passive investing. It's not to say you're not going to do anything, but a lot of the work in private lending is kind of upfront, set it and forget it. If anybody's old enough to remember those old infomercials with the rotisserie chicken cooking thing, the set it and forget it, that's pretty much the model for private lending. So why would someone want to do private lending? Well, it turns out most people, you talked about bigger pockets, most people started investing in real estate because they had some monthly income goal number, right? Everybody talks about financial freedom. Before the recession, everybody talked about $10,000 a month. I've polled a lot of audiences. How many people have that $10,000 a month goal? And there's probably some people here that are like, yeah, $10,000 a month. Well, after inflation, it needs to be like 12, but everybody's still stuck with the 10. But private lending is purely a cash flow game, 100% a cash flow game. And the funny thing is, the benchmarks people like to talk about in real estate tend not to revolve around their goal. So for example, they'll say, I have 100 doors. Well, that's great, but you might be like 0.05% of 100 doors, and you might be getting $600 a month for your 100 doors. That's great, but is that getting you any closer to your $10,000 a month goal if that truly was your goal? Or they'll say, I have a net worth of $2.4 million. Well, 90% of it's locked up in equity in your property, and you're making $150, $200 a door on your 6 doors. That sounds great on paper, but is it getting you closer to your goal? Versus if you can get a hold of $1 million cash, lend it out at 12%, that's $10,000 a month with essentially no overhead, no tenants, no mortgage, no repairs, no pop-up expenses. The furnace went out, no phone calls on Sunday night, the hot water heater blew up. And when I bring that to people's attention, they're like, wait, what? And then they say, well, what if I can't get my hands on $1 million? Okay, well, can you borrow $2 million at maybe 6% and then lend it out at 12%? Because that's still $10,000 a month. And they're like, wait, what? And I'm like, yeah, this gets funnier. How many times do you want me to do this? Like you can change the numbers and change the interest rate, and you're still going to be able to end up with $10,000 a month reasonably, that I think most people could potentially get their hands on. And when I explain real estate investing to people that way, when that message resonates with them, they're like, oh my God, like, yeah, I don't want to own 50 houses. I don't want to have 50 single family homes. I don't want to have 50 doors. If I can just end up with $1 million making 12%, that's $10,000 a month. And I'm like, yeah, cool. Like that's it. And the reason I bring that up now is not a lot of people have the conversation very early on in their real estate journey that says, what do I physically want to spend my time doing? Everybody's like, I want to get out of my W-2 job. I got to exit the rat race, like Robert Kiyosaki's rat race, right? I got to exit the rat race. And you're so focused on where you don't want to be, you don't pay attention to where you want to be and where you want to go and what you want to do while you're there. And investing is not going to be a quick journey. There's probably several people in this room or several people watching this recording. You might be early on, a year, 2 years, maybe 3 years into your journey, 10 years down the road, potentially you're still going to be invested in real estate. So you have to invest in a way that works for your lifestyle. And if flipping fits your lifestyle and fits your personality and fits your time constraints, fantastic, do that. I think it's a viable way to invest. But I'm just here to say that it doesn't fit my personality, it doesn't fit my lifestyle, and it doesn't fit my goals, because my goal is I'm a cash flow investor. I have a horse that eats around the clock, like $20 bills every hour. So I need cash flow. So something like me investing in, say, ground up construction of a multifamily deal that might not cash flow for a year, 2 years, depending on how slow the construction is. That doesn't fit my lifestyles. That doesn't fit my needs. But does that mean it's bad? No, it just doesn't fit me as an investor. So before I think you kind of really explore any way of passive investing or investing in general, it's really think about what is it that you're trying to get out of this investment? And also, what are you trying to add to your lifestyle? Because every form of investing, even though it says passive, there's still going to be a little action. There's still going to be a little thing, due diligence you're going to have to do on your part to make sure it's an investment that fits you, your criteria. Talk to your CPA, your legal professional. But this is the method I have chose to invest in real estate because I needed geographical freedom, because I'm currently sitting my 19th address in 21 years because I'm an active duty military spouse. It allowed me time freedom because we're always somewhere, we're always doing something. We oftentimes will get a 2-week heads up that we're moving across the country. So it's like, okay, cool. Me having a career was not really something that was ever going to truly be possible with the lifestyle, because I chose to keep my family together. So that is why private lending kind of landed in my lap, and why I continue to pursue it so fervently, because it's a way that fits my lifestyle versus me trying to create this very busy world and think my metrics of success is how many properties I own or how many doors I have control over or partial control over. That's not my metric. That's not my definition for success. My definition of success is, do I have time freedom and do I have geographical freedom? And that's success to me. So just letting people know that. This I just threw together. I think Matt did a pretty good job kind of explaining during my introduction. But I do private lending. I lend out my own capital, and I also broker capital for individuals that want to invest in this capacity, but maybe don't want to source deals, don't want to worry about documentation, don't want to do the underwriting. I also run a free educational group, Private Lending Lessons. It's on Facebook. So feel free to post questions. People can respond, hey, what are the market terms, or what should I be worried about? Or, what do I do if a borrower does this, that sort of thing. And then obviously actively lender as well. Now, I know this particular audience might be a little more geared towards passive, but just to kind of give you an overall framework of the lending space, think about the lending space as this kind of big umbrella. Most people are very familiar with the conventional lending space. That would be a Fannie Freddie Mac loan. Like you go to your bank and you get a 30-year fixed for your primary residence, you move in, maybe a VA loan if you're military affiliated. Those are what's called conforming loans. They are backed by the federal government in some capacity. They're conforming because they are exactly the same thing, just printed with new names and new addresses. Nothing changes. Where private lending or investor capital kind of fits into that lending umbrella is kind of over on the other side. We are very much not conforming. So a lot of our terms, you'll see this, investors will see this in a DSCR loan. They'll see it in construction loans. They'll see it in hard money loans. A lot of hard money lenders are now calling themselves private lenders, which is causing havoc for borrowers because they don't know if they're talking to someone like me or if they're talking to a hard money lender. But we are on that other side of the umbrella where things are not so conforming. And the reason I bring that up, you'll see in a little bit when we talk about terms of the loan, is that we are specifically lending on investment property that you are not going to occupy. Your borrower is not going to occupy these properties. That includes short-term rentals that are occupied more than 14 days out of the year by the owner. That includes, the live-in hack. So if you have a duplex and you're going to live on one, the borrower's going to live on one side and they're going to rent out the other, that's still their primary residence. We are always in the scope of lending on business purpose. So I try to have that distinction very clear that we are not lending on people's primary residences. We are lending purely on investment property, like a hard money lender, like a bank would for a construction loan, like a bank would for DSCR loans, the debt service coverage ratio loans. And like I mentioned, private lending has that nice little niche where we are kind of out of the scope of federal regulation, which is what conforming loans are. It requires federal licensing, federal oversight. Private lending, on the other hand, is business purpose lending, is actually controlled on the state level. So our oversight is 50 different states. So that's why I say specifically the states I lend in. But where we fit in is we have a nice little niche where it's either distressed property, somebody wants to be able to close quickly. Maybe they don't need the loan for that long. So they have another couple flips that they're selling and they just need down payment money until those two flips close and they can pay the money back. So our loan terms are generally going to be shorter. The underwriting tends to be less intensive than a conforming loan. So yeah, we'll ask for some documentation, but that's literally just to kind of prove what you're saying is correct. And there's some legal things we need to make sure. But it's not going to be like a lot of private lenders like myself. We're not pulling credit. We're not asking for tax returns. It's a lighter underwriting. So it tends to be a quicker process to be able to close. We closed one a couple months ago. It was 48 hours from the time she put in an application to the time we had to send docs out the door, because her other lender had fallen through at the very last minute, the 9th hour. And she's like, oh crap. So it's something where generally, if once you kind of have that muscle memory, you can close a little quicker. Generally, it's interest only payments. So even though the interest might sound high, anywhere between 10 or maybe 14% on an annualized basis, because the loan is such a short duration, and also because it's interest only payments, it tends to be a little more manageable versus, someone, I love when people say this, they're like, oh, I have a 3% loan. And, I hate to sell the property, or I hate to refinance the property because I have that historic low 3% loan. And I'm like, you have a 3% fixed rate, 30-year amortized loan. I promise if you add up the amount of interest you've paid, especially in those first maybe 5 to 7 years, you're paying a lot more than 3% interest. So these are simple interest loans. So 12% is 12% is 12%. So it's not any of the magic math with amortized loans. And there's usually a balloon payment at the end. The other kind of caveat is commonly the borrower is a business entity. So on the conforming side, it's always going to be Mr. and Mrs. Smith, or, Bob Jones. It's always going to be an individual. Conforming loans are not going to be out the door to a business entity. Whereas a lot of private loans, hard money lenders, the debt DSCR loans, those are generally going to be to business purpose. So they're going to be for business entity borrowers. Now, the common terms, like I talked about, a lot of active investors, I get this question all the time. A lot of active investors, they come in hard and fast. What's your rate and terms? What's your rate and terms? And I will tell you, and they get a little surprised, that is not the most important thing to know. So, because like I mentioned, you're only going to have the loan a short period of time. So if someone is telling you 11% and I tell you 12%, and that's the only basis you're going off of, and you go with the 11%, well, maybe the 11%, when you get to closing, you find out that they want you to pay those 12 months of interest ahead of time, and then they're just going to credit you back as the loan matures. I've had that happen to a borrower. They were adamant they were going to go get 11% with someone else. I was like, go for it. That is fine. This is what I'm pricing the loan at. I was at 12. And they ended up having to show up to closing with $15,000 extra that they weren't expecting, because the other lender wanted 6 months of prepaid interest collected at closing. But since the borrower never asked that question, all he ever asked was, what's your rate and terms? Well, he told him, and he told him a number he liked. So on this screen, I'd try to put in some other aspects to the loan that could potentially be more helpful or more informative to ask a lender or for a borrower to kind of think about. So obviously the origination points, we talked about that. Usually they're anywhere between 2 and 4%, maybe 1 and 4%. The fun thing about origination points, though, if it's a private lender that has control of their capital, they possibly won't make you pay the origination points at origination. I had a borrower that was like, hey, can I roll these into my payoff? Like, I'll do your 3 points, but can I roll it into the end of at your payoff? And there was plenty of room in the loan, really low loan to value. So I was like, sure, that makes sense to me. And we found other ways to mitigate the risk. And I was like, sure, roll the origination points into the end of the loan. But unless you ask those questions or even know that's an option, you're just gonna roll right in with what's your points and what's your fees and what's your rate. And it's like, well, let's have a conversation. The fees, again, a lot of times we're not having like a credit report fee. Most private lenders aren't pulling a full appraisal. So there's not going to be some, $600 to $1,000 bill for an appraisal. We're not doing those types of things. If there's fees involved, it's usually like a doc prep fee for the legal documents to be drawn up, maybe an underwriting fee, maybe a processing fee. So generally about $1,000 or less in fees is pretty typical for a private loan. We talked about the annualized interest rate, anywhere between about 10 and 14% on an annualized basis is pretty typical for a first lien. The other thing is a personal guarantee. This one will catch borrowers a lot because, again, they're very zeroed in on the rates and terms. But personal guarantee, does the lender require a personal guarantee? Does the lender require everybody that's a member of the business entity to sign the personal guarantee? Does the lender require the spouses of all of the members of the business entity sign a personal guarantee? Again, that's another question that not until the day of closing, when the docs are sent over to the title company, and then somebody finds out that their wife needs to sign, but their wife doesn't even know they're buying the house, so, but they don't think to ask those questions because they're looking at the rates and the terms. Loan term, you got a question?
Yeah, I had a quick question on personal guarantee. You mentioned earlier that I guess part of the benefit of going with a private lender is you're minimizing the documentation and the underwriting. And you mentioned even kind of like not taking tax returns and some of that stuff. So how do you, I guess, get comfortable if you're doing personal guarantee? Is that one and the same? In that case, you do have to kind of pull that information, right? Because otherwise you're not sure what you're getting behind a personal guarantee.
So the personal guarantee component, one of the things I ask for example, is a schedule of real estate owned. So I want to see what kind of real estate you have, what kind of equity you have, but also what kind of experience you have. So that will include properties that you've owned over the last 2 years if you don't currently own them. And then the other thing that some private lenders will ask for is they'll ask for some sort of asset statement, a brokered statement, something like that shows they have enough funds to close, or maybe they have enough funds for the projected rehab. If they're only lending on purchase price and there's a $30,000 rehab, we want to make sure you have $30,000 available to you to do the rehab. The personal guarantee really comes into play after the property. So for example, we're just going to say nuclear option, worst case scenario, the property has to be foreclosed on. If it does not sell at auction for what our reserve amount is, then it comes back on us. And then for us, as a lender, do we flip it? Do we fix it? Do we turn around? Do we sell it? Anything that is between that deficiency of what we lent and what we actually got back, that is what the borrower would then be personally guaranteeing. So in our case, we are trying to lend at around a max of about 70% of the after repair value. So if prices drastically drop, then we could potentially be underwater. If for some reason the borrower walks out after they've demoed everything and taken it down to the studs and they're like, cool, peace out, then we could potentially be a little bit underwater on a property. So we try to mitigate the risk and the need for having a personal guarantee, but we do have that personal guarantee as kind of like a third fallback. So if it doesn't sell at the auction, at the courthouse steps, through a foreclosure process, if it doesn't sell for that, we end up with it, we can't sell it to get our capital back or whatever, then that third line is that personal guarantee from that individual. And it's generally not for the entire loan amount.
Right.
I hope that answered your question.
Yeah.
Okay. We talked about loan terms. Loan terms generally are going to be 6 to 12 months. I do know active investors that specifically kind of, I call it, create their little private lending army. So that's individuals that may not self-identify as a lender, but have $100,000 in a self-directed IRA that they want to invest in real estate, for example. You can talk to them and say, hey, instead of trying to churn this money every 6 or 12 months and find a new deal and find a new borrower and do all this due diligence, let me just have this capital for 36 months on this one property. And then that active investor will turn it into a rental, maybe do a lease option to a potential new home buyer. And so there is opportunity to have this private capital longer, but generally someone that's going to self-identify as a private lender like myself, think in terms of months, not years. But there is a capacity to build that kind of little army, like I said, that they just want the capital, set it and forget it. They want the monthly payment. Lien position, this is a big one. So hard money lenders, DSCR, the bank financing, they're all going to want to be in the first lien position. There's a little bit of a market coming into play for second liens, just because they see so many investors that, they have the great rates. They don't want to lose them. So they don't want to do the refinance. So to kind of keep the deal flow going, they're allowing investors to access capital potentially through a second. But some private lenders will lend in the second lien position. If an active investor has ever heard the term gap funding, that can be a second lien loan. So again, if you're coming in on hard on rates and terms and you don't ask other questions, you don't know these other doors are open. Loan to value, I talked a little bit about that. That's going to range wildly. Some lenders are like, we don't want to go over 50%. Some lenders will go up to 80%. It really depends on their risk tolerance, the type of project, maybe the market the property's in, maybe your experience as a borrower. But generally, I'm going to say tops out at maybe 75% realistically of the after repair value. And then the last thing that a lot of investors don't think to ask about until they've run into this problem is construction holdbacks. So if we are lending capital for some component of the rehab or all of the rehab, we are not having an investor walk away with $30,000 at a check at closing and hoping they do the right thing, because nothing's legally stopping them from going to Vegas and have the weekend of their life if they're getting capital at closing. So they're going to have a little bit of money ahead of time to get the project jump started. And then they're going to submit receipts to us as a lender and say, hey, look, I put on a roof, I put on the AC, here's the $5,600 in bills. I would like a draw, please. So that's another thing, another question to ask is if you are preparing to lend on the construction component, how are you going to handle those construction draws? What are you going to do with your borrower? Are you going to let them leave closing with capital? Are you going to let them leave closing with a little bit to get the first phase of the construction process started? And again, it's another question a lot of borrowers don't even think to ask, how do you handle the construction process? And then this is probably the second most common question I get from people that they kind of have a deal in the hopper. They had someone approach them and say, hey, like you could work with me, you can invest with me. Why don't we just do a private loan? They're all jazzed about it. Like, what do I need to do? And it's like, okay, well, there's a lot you need to do. That's why there's a book, but this is the bare minimum you need to do, right? You need to have this, what I call the securitization documents. Some states are deed of trust states. Some states are mortgage states. A few are both. So making sure you have that securitization document, that's actually going to be the document that is recorded in public records that shows your lien on the property. If you don't have anything recorded in public records, you do not have a lien on the property because nobody knows that lien exists. So that is a very important document. That's why it's very first thing on the screen. Second thing is hazard insurance. This is going to sound a little weird, but the other thing I like about private lending as far as investing in real estate, it is the only way I know of for investing in real estate where other people pay their money to protect my money. So they are obviously, the borrower is going to go get hazard insurance on that property. So in case it floods, fire, et cetera, that it's covered. So I am added as a lender, as a loss payee, mortgagee on their insurance policy that they are paying for. So if there is a claim made, if the policy lapses, if the policy is canceled or altered, I am made aware. And as a loss payee mortgagee, the capital kind of has to flow through me. The check will sometimes be written out to both parties, to the lien holder and the borrower. So that's another way to kind of keep your eyes on the property and keep your capital secured. Title insurance, I can't understate this enough. As a lender, having a lender's title policy for every property that you lend on, that's going to guarantee that there's not other liens kind of out there. So if Bob the borrower, comes to you and says, hey, I have this great opportunity for you to work with me and invest with me. There's nothing that will be able to tell you he hasn't done that to 6 other potential lenders if there's not something recorded in public records. So if you don't go get title insurance and you don't go record anything, this $100,000 house could ultimately end up having unsecured debt way beyond $100,000. We actually had that happen. A investor went to jail here locally in Virginia a couple years ago because he had a property that was worth about $300,000, but had managed to rack up, I think it was ended up being about $3 million worth of debt for associated with this one property. And there only was 3 liens actually recorded, but he had just been, hey, I'll invest with me, invest with me, invest with me, and signed a promissory note. And these people thought that their loan was the first lien on this property, or maybe even the second lien on this property. And it turned out there was no lien at all because nothing was ever recorded. So having title insurance will let you know if there's other liens outstanding, what those liens are, and if there's any other clouds on title. We talked about the loan to value evaluation. You want to make sure you're not so far up where you could potentially end up underwater. We talked about having a construction holdback agreement. So you and the borrower have a discussion. When are funds going to be dispersed? How are funds going to be dispersed? Are you going to be doing it in timelines, phases of construction, as receipts come in? How busy do you want to be? And then this sounds weird, but lastly, the promissory note, because the promissory note is really just kind of outlining the kind of standard agreement for what the loan's going to be, the interest rate, how payments are made, where payments are sent to, blah, 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 blah. Everybody seems to zero really in on the promissory note. I'm like, you need all of these, but the securitization document, in my opinion, is the most important, because that's the one that's going to show up in public records and let other people know that you are owed money for that property in some capacity. And then this is probably the third most common question I get asked about private lending is, what are the different ways I can invest? Like I mentioned, we will broker for individuals because there are individuals out there that want to invest in this capacity, but maybe they're not comfortable with their knowledge base. They're not comfortable with the process. They don't know how to do the underwriting. They don't want to do the underwriting. So there's different levels of active and passive for private lending. The most active would be kind of what I do, would be the originating and the funding of loans. Next one up would be what I call brokering. So you're working with someone to place your capital. You still have that securitization instrument, whether it's a deed of trust or a mortgage. It's potentially in your name. It should be in your name or your business entity's name. And then the upper one would be something like a debt fund. This would be similar to the Reg D, the 506B, 506C route, where the capital, instead of going towards the down payment for a multifamily, or maybe the closing costs or rehab for a multifamily, that capital is being pulled together and then lent out into investor loans in some capacity. That would be a debt fund. And then this is just how you can get a hold of me. That's my email address. You can reach out anytime. I have a very rudimentary website. A lot of my business is organic, but it'll talk a little bit about what our lending criteria is, and you can kind of see how specific we get. Like I mentioned, we have a Facebook group, or I have a Facebook group, educational Facebook group. And then always feel free to connect with me on LinkedIn. That's how I met Alina about a couple months ago now. We had a great conversation. So feel free to connect or send me a message there if that's your platform of choice as well. And other than that, I'm happy to take some questions if anybody's got any. Tried to stick to your 30 minutes. That
was, yeah, you got it. That was great. You went through a lot of interesting content. I liked actually the approach of kind of diving in a little bit and taking it back out. Really helpful. For everyone that's on the call, you guys have access to the kind of the Q&A or the chat box. If you want to ask questions through there, I'll screen those and then read those off to Alex. Alex, where I was kind of first thinking, and I'm sure many on the call who are not involved with private lending is thinking, like, is kind of like, where do you start? You mentioned like you can, you might have the money yourself, or you might lend the money and kind of do like try to get arbitrage on interest rates. But tell us like about how you got started and what was your first lending deal? What did that look like? What type of asset, what type of business plan they have, and how that all kind of work out for you?
So I got started by accident. This is just my life is a lot of accidents. So I ended up years ago, over 20 years ago, I got a job as an office manager for a company. And it turned out this gentleman was a private lender. He lent out his own capital. He did a little bit of brokering for hard money. And so back then, people had to write paper checks. There was no real thing as, cell phones. Everybody had a pager or a beeper kind of thing. And so I basically sat in his office and I did his books and I accepted the checks, for the people he had lent money to. They had to come in and pay their mortgage every month, and making conversation with these investors, hey, how's your deal going? Hearing about it, you know, I kept hearing a lot of the same things. I kept hearing, like, oh, there's problems with the contractor, the wrong flooring showed up, our permit didn't get pulled, our roof didn't pass inspection, et cetera, et cetera. But no matter what was going on, they were in this guy's office the first week of the month paying their mortgage. Tenant moved in, trashed the place. They were still at his office paying the mortgage every single month. And then this was also kind of back when, the phones weren't smart. Phones weren't even a really thing. They were sort of a thing. But I was driving out to the job sites, doing these construction holdback, evaluations. Yep, there's a roof on there. Yep, it looks brand new. And so I got to physically see a lot of what was going on from the borrower's perspective, things they were running into. I'm running out applications to them. They're filling out applications on the hood of their truck. So I really got to see the business of real estate from the other perspective, like from the lender's perspective. And as I kind of worked there, I was like, my boss is on the golf course. This is in Florida. Like, my boss is on the golf course like pretty much all day, every day. Like, I'm here keeping his little office up and running, turning the lights on and accepting faxes and doing some paperwork. And I'm running around town. And then I have these borrowers coming in and I just hear horror story after horror story. And I'm like, like, I like it over there. Like, I don't like golf, but I could manage. I could figure out some golf.
Yeah,
So
yeah.
that is kind of how I got started in it. And then my first lending deal as a lender myself, I was actually being in the military community. The circle, if you think about a Venn diagram, people in the military, people in real estate, there's a little overlap in the middle, which is a relatively tight-knit community of active investors that also invest in real estate. And we just happened to bump into somebody where we were stationed. We had been stationed with them previously, and they mentioned that they invested in real estate. And I was like, oh, I used to work in real estate and this is what I did. And he's like, oh, he goes, I really want to buy this house down the street. I was wondering if, do you want to partner on this? And I'm like, well, I don't want to own a house down the street, but like, I'll lend to you. And he's like, you'll do what? And I was like, well, like, my boss did it. It can't be that hard, right? Like, he wasn't Einstein. He could do it. I could do it. So got an attorney involved. The attorney did all the paperwork. I will freely admit I had no idea what I was doing. Very little due diligence was done on that deal. But the first loan that went out the door was about $67,000 and some change, because I paid for the purchase price, and then the partner did the rehab, brought capital and the sweat equity to the project. But we were the first lien holder on that property. And then kind of throughout the years, again, that Venn diagram of military people in real estate, and we were in the middle in that circle. We would lend to people that we'd bump into through the military, and it's usually lent in Florida because that was the market I was familiar with at the time. But then when the pandemic hit, like, it shut down the world, like, quite literally, but it really shut down the hard money lenders, the private lenders, the hard money lenders. Sometimes with like a day's notification, like, hey, I know we're supposed to close tomorrow, but we are no longer funding deals. And within that, like, first, second, third week in March, we started getting all these phone calls, people coming out of the woodwork and saying, hey, we did this deal, a couple years ago, this, that, the other thing. I got a deal. It's not closing, da, da, da. And so we just kind of took it as an opportunity, my husband and I, to just say, you know what, like, it's time. Like, let's make this a little more formalized. We had done several by that point, and we said, all right, let's really do this now. And that's when we really kind of jumped in and said, let's make this more formalized. Let's do this. And we've been doing it ever since the beginning of the pandemic, as a more formal business thing, as opposed to like some side hustle that when opportunity presented itself.
Really interesting. Thank you for sharing that. I'm going to read some questions that are coming in the chat box. So Eric has a question about brokering. So his question is, when you broker loans, do you usually take a spread or a broker fee, or both?
So my business model specifically is we are paid by the borrower. we keep the origination points and the underwriting fee, and then all the interest is yours as the we call them capital partners. As a capital partner, the interest is all yours. Different brokers have different models, so your answer is both. So some brokers will do some percentage of the origination points split with you. Some will do none. Some will do what's called a point spread, so maybe they'll take 0.5% of your interest on a monthly basis. It just really depends on what their business model is. So that's a good question to ask if you are considering having your capital brokered. Understanding what your return is going to be and kind of who gets which piece of the pie is very important. So I'm glad you asked that, Eric.
Excellent. Donna has a couple questions. I'll start with her first one that came in.
Sure.
She says, thanks for the great info. And what doc do you provide to potential borrowers to explain the whole process? Is there an education process? I was working on a lending to a friend, a flipper, and we agreed on interest rate, loan length, but she was surprised she would be expected to pay to record the mortgage. So I had realized I hadn't clarified the whole process in advance for her.
So as far as the kind of explaining the whole process, I don't think it necessarily explains the process, but what I pass out is what I would call a rates and terms sheet, but it's got a lot more than just the rates and terms. So for example, one of the boxes is how much capital you're expected to bring to closing, bringing to the title company. So I will work with the title company and get kind of a preliminary settlement statement, HUD-1, whatever they're using. And that at the bottom will have a number that says, this is how much we expect the borrower to be coming to closing with. And I will put that number on the rate and term sheet, so they're not surprised saying, hey, this is what the title company is expecting you to bring a cashier's check or a wire to closing. And they sign that rate and term sheet, so they understand that. So that is how I handle specifically kind of the money question. But if you wanted to, what you could do is just charge one flat rate and say, hey, it's going to be 2% origination, and then I have a $2,000 fee that covers X, Y, and Z. I personally wouldn't do it that way, but if that's how you're comfortable doing it and just being able to tell a potential borrower, hey, I charge 2% origination fee and $2,000, as an underwriting fee, processing fee, and that kind of encompasses a lot of different things. And you can kind of list those things out to kind of save them the sticker shock. You can do that. You're just kind of taking the risk that hopefully their lender's title policy, if you're going to roll that in there, their lender's title policy isn't too pricey. But yeah, I would say rate and term sheet being very upfront with how long the loan is, when the final balloon payment is due, what the annualized interest rate is, what their monthly payment is, how their monthly payment is going to be paid. So for example, we use a loan servicing company and they auto debit the payment within the first 4 days of the month. So the borrower is going to be expected to bring a canceled check to closing, so that has their ACH routing information. That's on our rate and term sheet to make them aware. We let them know they're going to have to bring a couple forms of ID to the closing. So we have all of that kind of outlined in our rate and term sheet. It's called rate and term sheet, but it's got a whole lot of other information on it.
Excellent. A couple more from Donna. She did mention she's a fan of your YouTube channel.
Oh, thank you.
So Donna, her next question was, do you have to keep checking if they're paying things like property tax, or does the borrower pay something like that a year ahead at closing? Does your book give details on how to create the checklist for the title company of all the funds and signatures that should be collected at closing from any borrower?
So for the tax question, generally, it depends on the municipality and how they handle, I'm assuming property taxes in this case. It depends on how they handle property taxes in that municipality. Generally, the title company will make sure that the taxes have been brought current as to the day of closing. They'll credit the buyer and the seller for X amount of days of ownership for that closing. Usually the private loans are going to be in such short duration, like I mentioned, 6 to 12 months, that unless it's a municipality that's really on the ball and you have to pay your property taxes quarterly, and if you don't pay them within those first couple of weeks after that first quarter, they're going to put a lien on the property. It's generally not much of a worry. Can you do it? Yes, you can go into the property assessor's office for that municipality and just kind of double check the due dates, make sure the property taxes have been paid. If for some reason a tax lien does end up on the property, you can pay the tax lien and then have that rolled into your payoff statement as long as your legal documents, which is why I'm so adamant about having a professional attorney that's familiar with lending draw up your documents, because you're going to live and die by those documents. So if for some reason a lien becomes more senior to yours, you have the ability to pay off that lien and then roll that into your payoff of statement when the loan comes due. So that sort of thing can be handled that way. As far as creating a checklist for the title company for the funds and signature, that's very specific per deal, and it's also very specific per set of documents. So for example, the documents that we have drawn up by our attorney, we have a new set of documents drawn up for every single transaction. We don't use a template. We have an attorney draw up documents every single time. Our documents are 72 pages long. There's 14 different disclosures. There's a promissory note, there's a personal guarantee, there's the securitization document, the deed of trust, all that stuff together is 72 pages. In that 72 pages is a document called funding instructions. And I believe that's probably what you're referencing here is funding instructions. And the funding instructions outline, borrower needs to sign on this line, borrower needs to fill this out. As soon as the documents have been signed, they need to be scanned in and sent back to me as the lender for approval. And then I will give you authorization to actually disperse the funds. That whole process, all that information is kept in a document called funding instructions. And so there isn't really a checklist for it because, like I said, it's very, very deal specific and it's very, very document specific. So that is something your attorney that draws up your documents should be able to help create funding instructions for you.
Excellent. And Donna, congrats. She did mention she has, she originated a loan and had it repaid, and it worked out great. So congrats.
Awesome.
Awesome. Yeah, I did have one question, kind of like I'm thinking about like the downside of like if you're running this as a business. I have to imagine you kind of like build in, like any business, right? There's going to be some point in time where things don't work out the way you had hoped, and some percentage of time, I'm sure that occurs if you do this long enough, right? So,
yep.
How do you like account for that in your business? I guess obviously with the liens and the guarantees and everything, you hope to kind of if things were to go that way, you hopefully can recruit funds, but is that kind of your line of defense? Are there additional lines of defense or planning beyond that you have if you kind of reach, $1 million out in loans, right? I imagine that's that type of volume. You start thinking about, okay, I have a portfolio, and at some point one of these are kind of go against me.
Yeah, the number one kind of strategy for private lending when it comes to operating a little more formally as a business is you're in the business of risk mitigation. And risk mitigation happens before anybody signs documents, right? It's that loan to value. Normally the first lever, if you think about a lever that moves different parts of this machinery, the first lever lenders are going to pull is that loan to value. They're going to go down on that loan to value. And active investors experienced this during the pandemic. A program where they normally could have gotten 80% cash out refinance all day long, 2 months into the pandemic, it's like 65% loan to value cash out refinance was the highest you were going. So that tends to be the lever investors are going to first. So if you're really, really worried about risk mitigation, lending less money on the same asset is automatically going to be less risky. So that's generally the first lever I'm going to encourage investors that are considering private lending is don't get crazy. Don't do second liens up to 100% loan to value. Don't do the gap funding where you're providing closing costs and rehab and everything after a hard money lender. Just do what feels nice and safe and normal. And if you want to know what those parameters are, start talking to hard money lenders in your market and get a feel for what their upper loan to value is. Do they have a prepayment penalty? What are their origination points? Are they doing construction holdbacks? What does that process look like? And you can start to get a feel for kind of like what the big guys are doing, because what the big guys are doing on scale, they obviously have higher ups, hedge funds, they're institutionally backed. They have a warehouse line of credit or something. They have people that they report to. So they have to stay within those error margins of things like default and lates and things like that. So if you're kind of wondering like, what should my loan to value be? What should my rates be, et cetera, just start secret shopping hard money lenders in your area. Because if you start hearing, we'll go up to 70% loan to value, we'll do 90% of purchase price, we'll do this, we'll do that, and you hear that routinely, then you kind of know that's where their safe zone is, and you're probably good there or below that safe zone.
Great advice. My last curious question, and others, maybe we'll take one more in the chat box if you guys want to drop one more in there as well, but was curious thinking, again, thinking kind of back to your earlier days, how do you build, you had mentioned you almost accidentally got your first deal and maybe that kind of snowballed, but at some point, did you actively build a pipeline? And was that more in doing that? Was that more of like networking with folks who are in real estate and specifically in kind of flipping or short term kind of projects? Did you actively do that, or did it kind of just come to you, or like how was that? How did that, I guess, phase of your business look like?
I will say the private lending, I tell everybody our space, we are the champions of hide and seek. Because we are not publicly going to come forward. Because you got to imagine, think about going to a local RIA meeting, before the pandemic and shut the world down. You went to these in-person meetings and there might be 50 people, 100 people, depending on your market in that room that particular night. You are not raising your hand and saying you have capital available to lend, because you are instantly going to become the most popular person in the room. So we are a community of lurkers, as creepy as that sounds. So I tell people, even because we welcome active investors in our private lending community, because I want them, that you can't have a successful loan transaction without a successful borrower and a successful lender. So active investors are welcome in the community because, and I tell them, I'm like, participate, ask questions, interact with other people, because the more people kind of see your name, they're like, oh yeah, I saw him respond, or I really liked his answer, or she brought up a really good point. And that's kind of how we build kind of a network in, the 21st century post-pandemic. It tends to be very virtual. It's not a lot of RIA meetings, it's virtual networking. You kind of bump into people, making a Facebook post, or you respond to somebody's Facebook post, or LinkedIn is another one, Instagram, things like that. So it's a lot of just kind of bumping into people, and then you get a sense of like their demeanor, what are their risk tolerance? What are they talking about? Are they talking about how they screwed over their last 3 business partners? And now they're like, oh, they just got this great new rehab. I'm like, oh, I'm not touching that with a 10-foot pole, because I've been listening to you talk about how you screwed over your last 3 business partners for the last 10 minutes. So we're not going to, like, a lot of private lenders, people that are like me, private lending, are generally not going to come forward and say, especially in a packed room of investors, that we are a private lender. The private lenders that are coming forward in that capacity are probably more in the hard money lender space, but they are rebranding themselves as private lenders because they have capital all the time. Like private lenders like myself, we might not be liquid all the time. That's just the nature of the beast. That's how we are. Our capital is finite. Whereas if you're a larger, more brick and mortar type business, you have institutional capital, maybe you have a hedge fund, maybe you have a debt fund backing you, you have a little more liquidity than individuals like myself that have smaller businesses. Not to vilify them, but they call themselves private lenders. And when a borrower comes up to that person, that experience is going to be very different than when they're talking to an individual like myself, because that hard money lender, calling themselves a private lender, the hard money lender is going to, a lot of times they're going to check credit, right? They're going to ask for tax returns. They're going to ask for bank statements. It's going to feel very much like a conventional conforming loan, because they're turning around and selling the loan off as soon as the ink is dry. Whereas we're keeping these loans, we want to know the people. It tends to be more relationship lending on our business model than it is about deal flow. So like a lot of the borrowers I've had have been repeat borrowers. They'll call dibs on the money before it's even come in. They're like, hey, I know I have that flip that's selling in 2 weeks, but I just got another one under contract. Can we just kind of, do the thing? And they're like, yeah, okay. So this business model tends to be a lot more relationship focused than it is a transaction. I tell people all the time, we're not going to be the cheapest thing. We're not going to be Walmart. We're not going to, be the bigger, better deal, the lowest thing on the block. But, if we say we're going to close, we're going to close. We're going to be upfront. We're going to have a conversation. You put in an application telling me this property was 250. I'm feeling it's a little more like 235. What are your comps? Let's have a conversation. Why do you feel it's 250 when I'm pretty sure it's 235? Let's have a discussion. Whereas you can't really do that with a conventional lender. You can't do that with a bank. You're definitely not going to be able to do that with a hard money lender. So that's why, I really hammer home, like when the people start coming in hard and fast, I'm like, what's your rates and terms? It's like, we need to have a conversation. Like this is not what you're used to expecting.
Yeah. Final question again from Donna, which also was a question I had, was contemplating earlier, was, I'll expand upon your question, Donna, but Donna's question specifically is about a maximum or minimum loan amount that you kind of target. But more broadly speaking, maybe, do you, as a private lender, kind of have this criteria of, this is the space, this is the type of asset I'm getting into, or business plan that I kind of want to fund? Or are you kind of all ears? If it, if it makes sense and pencils out, you're in? Or do you kind of create a niche and stay within like a kind of a zone that you're comfortable with?
So for the max and min specifically, for my lending criteria specifically, it's going to sound really funny, but I'm trying to stay within the shadow of more permanent financing, whether that's DSCR loans, whether that's commercial, whether that is conventional, because it's called an exit strategy. Whatever that borrower's exit strategy is, that's what's paying off my money, right? So if they're flipping it, then there's going to be a retail buyer. So I need to kind of have an understanding, like, what does the retail buyer financing space look like? How much are they willing to lend? Under what conditions are they willing to lend? Is this a house that's going to actually sell for the upper retail price, or is it in a neighborhood where there's going to have to be some seller concessions, et cetera, et cetera? So a lot of the lending criteria that I specifically put in place is centered around how is my borrower going to get me my money back? And the vast majority of the time, they're going to do that by obtaining other financing or bringing someone else into the picture, a new buyer that's going to be obtaining financing. So as far as the lending criteria, that's what I try to look for. The maximum amount, it really depends on the capital we have available. Specifically, I don't want to have too much capital tied up in one specific borrower or one specific project. So for example, if you say have $500,000 that you want to lend out, it might not be great to have all $500,000 tied up in one, luxury flip in Kansas versus maybe having 2 or 3 smaller properties in 2 or 3 different markets across 2 states. Just for diversification. That's my risk tolerance. If you feel free, put a $500,000 into one borrower, go for it. The minimum that really falls back into the more permanent debt financing criteria. A lot of lenders right now are having a hard time with $100,000 or less. That minimum loan amount tends to be right around 100,000. It's harder and harder to find lenders that are willing to do permanent financing for under that $100,000 mark. Maybe some small regional local banks will go down to maybe 75. 50 is going to be very, very hard to find. So when you're talking about being in a first lien position on a property that's only going to appraise out at maybe 50 or 60,000, and there are places in this country still where that's a real possibility. They have a house that's only going to appraise for maybe 60,000. Even if it appraises at 80,000 and they only go up to 60 or 70%, you're really, really close to that minimum that permanent financing is going to put in place. So I would just be cognizant when you're talking about minimums. I would be cognizant of what that end financing situation is willing to fund. If they're going to flip it and you think there's a good chance a retail buyer is going to be able to come in and buy it for 80, 90,000 as a homeowner, there's probably more programs available to that homeowner to get financing for $80,000 or $90,000 than there is to an investor who's trying to get 70% of $80,000 or $90,000. So that's the minimum component if you're talking about a first lien. If you're talking about a second lien, the minimum and maximum is really dictated by what's called the combined loan to value. So whatever that first lien is, if they already have a first lien up to like 70 or 75% of the ARV, there's no equity buffer for me as a second lender to come in, because if they default on that first lien, their default interest, their legal fees, anything like that is going to wipe me out. So I would say the minimum and maximum, if you're looking at doing something like gap funding, really is going to be dictated by the combined loan to value, not a dollar amount. And I hope that answered your question, Donna.
Great. Alex, we've used all the time that and it was a really, it's private lending, maybe not the sexiest topic, but I found it to be an entertaining hour.
Right.
So yeah, I appreciate you taking time today. This was really insightful. Like I said, it was a topic that we haven't went deep on before as a group. So I thought this was a really good both overview and detailed session. So thank you for that.
Yeah, absolutely. Feel free to reach out, ask questions. Obviously, I enjoy, talking about this and educating others because I would rather they spend a few minutes learning how to really secure their money versus, they gave $25,000 to their cousin's best friend who decided to be a flipper because, they lost their job during the pandemic. I'm just like, no, please don't do that. That's not private lending.
There you go. Yeah. All
Uh,
right. Well, thank you again. And thanks
Thank
everyone
you.
for attending live. And those of you that are watching this afterwards, hope you enjoyed it. Alex shared her contact information earlier on the screen, so you can scroll back to see that. And Alina and I look forward to connecting with you guys. Please reach out. You guys have our contact information from prior sessions, but I look forward to seeing you all again next month.
All right. Thank
Thanks,
you.
Alex. Thanks, everyone.